basic accounting terms that every startup founder needs to know. Hi, my name is Alysha Randall. I am a fractional CFO, and today I want to go through the real basic accounting terms that you should really know as a founder. You may not have been exposed to accounting at all, particularly if you're brand new to the startup world. Welcome. And so I thought I would do a 3 parts on accounting terms, essentially a glossary, but explained rather than just a list. And so this is part 1. What I would like to do is just go through the real, the foundations of accounting. This is very much accounting 101, but I think particularly, again, if you haven't been exposed to accounting terms or finance before, and you maybe you're too scared to ask somebody what is an asset, for example, then this is the video for you. If you know the basics already, that's great, but maybe subscribe so that you get part 2 and part 3, and then we'll go through a bit more detailed, a bit more difficult accounting terms. Okay, so number 1 is asset, as I kind of mentioned in the introduction. So assets sit on your balance sheet. So as far as financial statements are concerned, and I'll link balance sheets above if you want to understand what a balance sheet is. But essentially, the asset is what your business owns. So whether that is the laptops that you purchased, whether it is furniture that you purchased, vehicles that the company paid for, it can be things that you can't touch. Physical things like computers and furniture. It may be a website. So you have purchased a website and you own that. It may be your IP, any copyright, brand names, particularly if it's significant, investments in other companies. And then you have your liquid assets. So that would be things like cash, for example. What is your bank balance in your cash balance in your bank account? That is certainly an asset. What about the amounts that people owe you? That is an asset as well, because you technically own that cash. You've delivered a service. You've done your part of the agreement. Now the bit that is owing, the accounts receivable, that is an asset for the company. Anything that you've prepaid that you haven't received yet, that is a liquid asset. So thinking about, where the kind of value, if you were to sell your company tomorrow, let's ignore future revenue, but if you were to sell tomorrow and you just looked at all the assets that the company owns and you are selling those, that is the definition of an asset. Okay, number 2 is liabilities. So this is basically the opposite of your assets. Again, this sits on your balance sheet. I'll link that below as well. And what it is the opposite, everything that you owe. So whether that be invoices for suppliers, whether there's significant amount of debt, like a loan, for example, your credit card balance, that is a liability. Anything that you owe employees, or say the government or tax department, HMRC, for example, in the UK, for pensions, for your superannuation in Australia, or anything, taxes that you owe the government. So VAT, GST, sales tax, or any employment taxes, any of those kind of things that you owe, that is a liability. And again, that sits on your balance sheet. And then the last element on your balance sheet is equity. So what this is basically it's the ownership value of the business. It is assets minus liabilities, basically. So it's saying how much profit has your company made in the past and contributed to your assets minus liabilities, and how much have people invested in the business. So if you have an investor that invests, say, £500,000 in the business, you're probably going to get that in cash. So that means your assets goes up by £500,000, and then the value is then sits into your equity. So if you think about equity as assets minus liabilities, sits on your balance sheet, that is a good way of thinking it. Okay, number 4 is revenue. So this is probably one of, again, an easy way, an easy accounting term that you probably already know the answer to, but essentially it is any income that is generated from normal business operations. So in the prior example, when I had someone invested in the business and they gave you 500,000, that is not revenue from your business operations. That is a separate thing that wouldn't go through your P&L. But if you're in business because you provide a product or a service, any income that you get from those, the selling of those products or services, is your revenue. And the timing and when we record that, I'll go through in another video. The next one is expenses, and this is essentially the costs incurred in order to generate that revenue. So whether it is your team, whether it's rent, whether it's legal fees, accounting fees, whether it is the cost of the product that you're going to resell, all of your tech subscription costs, all of those kind of things, that are your expenses. Number 6 is your profit and loss statement, your P&L, your income statement. Just like your balance sheet, I created a P&L explanation for founders video. I'll link that here above and below. But essentially, this particular financial statement just summarizes your revenues minus your costs and expenses over a particular period. So you may look at, say, a P&L statement for the month of, or for the quarter of, so 3 months worth, or for an entire year. And it will just include all of the revenue and expenses within that period. And so your monthly management accounts would be just of a 1 month period, for example, and you would compare the P&L from prior months, the same month in the prior year, year to date. So, let's say January to May, for example. Number 7 is balance sheet. I have kind of touched on this, but this particular financial statement just includes all of your assets, all of your liabilities, your equity. So it balances because asset minus liability has to equal your equity. And if it doesn't, you need to speak to your accountant because they've made a mistake. But essentially, this is always at a particular point in time. So a balance sheet is always as at the 31st of December. So it includes the beginning of the business. So say you started the business, I don't know, on the 1st of January 2017, and then your financial year is calendar, and then the 31st of December 2023, you would include all of the transactions that happened to your assets and liabilities since 1st of January 2017 to the 31st of December 2023. And the reason for that is, say, for example, you bought a building on the first day of business. Well done. So you've spent, say, £2 million on a building on the 1st of January 2017. At 31st of December 2023, that building still exists. You don't, write it off. You don't look at a balance sheet that doesn't include those earlier purchases. So things may come off the balance sheet. They may, move between your financial statements, but they certainly, will stay on the balance sheet until it is moved off. So again, I go through this in the balance sheet explainer. Then we have number 8, and that is cash flow. So this is the last of the 3 financial statements, and this is basically the net amount of cash that is being transferred in and out of the business. So a cash flow statement will have all of the different groups of cash movements. It'll have your opening cash balance, the total movement, so cash burn, or you may have got a cash gain in the period, and then your closing bank balance, again, of a particular period. So I did a cash flow explanation. So if you want to understand cash flow reports better, be sure to take a look at that video as well. Okay, so then we have debt. And whenever we talk about debt, it generally just means money that is owed by the business to another entity. So you could think about it, like with your liabilities. So you have your supplier debt, you have, longer term loans that you have credit card debt. So it's anything that you owe another company. That is what we think about when we think about debt. So we then have, in accounting land, we then talk about debits and credits. And this is a way of transactions being recognized within your financial statement. So it'll either be a debit or a credit. Now, if we let's focus on the balance sheet. A debit is generally, it's a way of recording an entry, a transaction of an amount that is owed or listed on the left-hand side of the account. So I would always explain debit and credit on a balance sheet because it is the way that, you think about things. So with a debit, it is if you're receiving cash, the debit would sit on the cash side. You're receiving cash. It's the amount that is owed, to you. And so, as I said, it's the left-hand side column of an account. I'll go through this in detail when I go through accrual accounting. And so it's thinking about how you would recognize the transaction. So anything that is owed to you and listed is on the left-hand side, which is a debit. You then have credit, which is basically the goods and services that you owe. So if you think about it, if you have a local pub that you go to, such an English thing to say, but say you have a local pub, you know them really well, they may give you a credit account. And essentially that is an amount that you owe. So if you are looking at your balance sheet, the liabilities are on the credit side. It's the amount that you owe other businesses. So when you're entering an invoice from a supplier into your balance sheet, the amount that you owe is the credit. And then the P&L is the opposite because you always have to have debits and credits. Again, I'll go through this in accrual accounting. So make sure to subscribe because that is in the next 1 to 2 videos is accrual accounting. So it's just a way of how we enter the transaction into the accounting software. Then we have accrual. So accrual, again, it can be quite, we can really go into a lot of detail and give you a finance degree, but essentially it is revenue or expenses that have been incurred, but the cash hasn't moved yet. So, or there hasn't been any documentation. So a perfect example is, I would say legal fees is one area that we always accrue for. We always create an accrual. So say, for example, at the end of January, your accountants will come to you and say, has your lawyer worked for you during January at all? Because we haven't received an invoice from them, we haven't paid them anything, but we know that you are speaking to your lawyers this month. And you might say yes, and you may have got a quote from the lawyer on the project that they were working with from you, or you can even ask your lawyer, how much, did you work this month? What is the amount that you'll invoice us for the work you did this month? Now, your accountants, if they're doing their job right, would raise an accrual. They would say, so when you get your management accounts in your P&L, it would say, say you did a project with the lawyers and they told you it would cost you £5,000 and they haven't invoiced you yet, then your accountants would raise an accrual. They would show in your P&L that you spent £5,000 on legal fees and the other side would be on your balance sheet. So it is saying this is how much expense we incurred in the month, whether the transaction happened or not. So that's what accruals is. Okay, the next one is number 13 is gross margin. And this is the difference between revenue and cost of sales, which is your gross profit. So cost of sales is any direct costs that you incur when you are delivering those revenue or services. So the easiest way to think about it is you have, say you sell a jumper for £100. It costs you £50 to produce that jumper, and say the shipping was £5, and say Stripe credit card cost you £2. So you had £50 plus £10 plus £2, that's £62. So your gross profit is £100, your revenue, minus the £62, which gives you £38 gross profit. So then we say, okay, so what is our gross margin? So that would be £38, the profit that you made, divided by the revenue, which is 100, and that gives you 38%. So we are saying that for the revenue on jumpers, you get to keep 38% of it, £38, after you have done all your direct, after you've spent all of their costs, all of your cost of sales. And this is really, really important because you want to understand how much profitability you get from each of your products and services, and it should be relatively consistent over time. But it's how can we make that better? How can we improve the margin and then in turn improve the overall profitability of the business? We then have cost of goods sold, which I, kind of explained there. It's basically, your direct costs attributable to the production of those goods or services for the company. With tech SaaS businesses, for example, they generally have a very high gross margin because their cost of sales are really low. Some of the cost of sales may be your merchant fees, so your credit card fees, and then they may have a little bit of tech subscriptions that they have to pay for, and ultimately increases the more customers they have. And that's about it. And the reason why their cost of sales are really low is because they have a huge cost in research and development, R&D costs, and probably they have a large tech team, which generally sits in your fixed costs. So they may have a high margin, which is why venture capitalists love tech SaaS businesses. But whereas the retail, for example, they might have much lower gross margins. Okay, so other kind of glossary terms I can think of is bookkeeping. So this is, often you might find that you need somebody to just manage the books. So dealing with invoices that received, invoices that you want to send out, manage your banking. This is called bookkeeping. It's just a recording of all the financial transactions that are undertaken by your business. And generally, if you're starting out, bookkeeping is something that you can outsource. You won't need a full-time bookkeeper. And if you want to understand how to do that, best practices, what to look for, tasks that you still need to retain in-house, and any red flags, I did do a founder's handbook that goes through outsourced bookkeeping, and I'll leave a link below for that. The other thing that I thought was probably worthwhile talking about is break-even point. This is kind of one thing that you may have heard a lot about in the news at the moment, particularly on social media, any kind of startup conversations, scale-up conversations, the break-even point. And what that means is the point at when revenue minus expenses equals zero, basically. So with most startups, not all, but with most startups that are looking for fast growth, they rely on the investment from VCs, PEs, angel networks, and then they're running at a loss. So their revenue minus expenses, the expenses are much higher than their revenues, so they are loss-making businesses. The break-even point is a point when it finally gets to zero, and then hopefully then it starts turning a profit. So before, getting to break-even point wasn't a big conversation issue with VCs, because we were in a bull market. Everyone was very positive. There's lots of money around to invest, and so VCs were happy to just invest in these fast growth businesses and just grow, and we'll worry about profitability later. There's now more conversation about at what point do you break even, and so that is what a break even point is. Okay, then we have budget and forecasting. So a budget is basically predicting, making an estimate of all of the income and expenditures over a set period of time. So it's usually something that happens just before the end of the year for the next year coming. It usually goes to the board for approval. It usually often goes to investors as an FYI. And so this is something that you kind of put together. It can be for a long period of time, 12, 2 years, 3 years. But essentially it is thinking about where you want to be at the end of the next 12 months. And then we have forecasting. So forecasting usually takes the budget and it actualizes the period that you've already done. So a very typical way of doing things is you create a budget, say, for example, for 2024, and then every 3 months you actualize the prior period. So say in April, January, February, March in your budget, you make that actual data. This is what actually happened in January, February, March. And then you potentially adjust these forecasted numbers so that you can still hit your year-end targets. With startups and scale-ups, we generally, you may want to consider a rolling forecast, particularly in those very early stages where a budget makes no sense whatsoever after a couple of months, and you may just want to forecast a bit more regularly because you're pivoting the business and doing different things and learning more data. So that's what a budget and a forecast is. Generally, if you're thinking about a variance, the variance, whenever you hear an accountant talking about the variances in the month, they're talking about the difference between the budgeted numbers and then the actual amount. So, for example, in January they may say we are budgeting £150,000 revenue, but you made only £140,000 revenue, then your variance will be 10,000. And then finally, audit. What is an audit? So an audit is when there's an official inspection of your organizational accounts, usually an independent body. So I'm ignoring personal. This is just business. So people that may audit your numbers would be a potential investor or doing a due diligence after you've signed terms. It may be the government. That's very common, or it may be an accounting firm. They're generally the three. It can be others like regulated body or whatever. But if we're thinking about accounting, what they do is they get access to all of your financial statements, and then they will go through them and they'll ask you to prove the numbers. They'll ask your accountants to approve the numbers. So, for example, if you have £1 million in your balance sheet as cash, they would ask you to see the bank statements that have that same number on your accounts. So that's what an audit is. Okay, just three more actually. So accounts receivable, this is money that is owed to a company from its debtors. So if you are a company that sends out invoices and then you wait for your customers to pay, the accounts receivable amount is the amount that is owed to you, the invoices that are unpaid in total. Similarly, accounts payable is money that is owed by the company, by the company to its creditors. I'm just like jumbling my words there. So if a creditor has raised an invoice and you've received the invoice and you haven't paid it yet, then this is your accounts payable balance. Inventory, this is a complete list of items such as property, goods in stock, and the contents of a building. So usually when I'm thinking about inventory, I'm thinking about products that are going to be sold ultimately, but haven't yet been sold. So if, for example, you purchase, we'll go back to jumpers. Say you are going to sell jumpers with your logo on it, and you buy 100,000 units of jumpers, and they're sitting in your warehouse. And in January, you sold 5,000 and you have 95,000 jumpers left. Then at the end of January, on your balance sheet, you will have the cost, not how much revenue you will get, but the cost of those jumpers on your balance sheet under inventory. It's saying this is how much product I have that I can sell. And this is an important number because obviously you don't want the inventory to get too high, because then you have lots of problems. We'll get through that another time. But they essentially were the main, basic terms that I wanted to go through. Hopefully that's useful, particularly for those who are brand new to startups and brand new to accounting. If there's any specific term that you feel that I've missed, please let me know in the comments below and I'll get back to you. But I do have another couple of videos on more terms to go through to kind of help with your knowledge. And then we'll go through some specific things like accrual accounting. Okay, hopefully that was useful, and I'll see you in the next video.